Previously, marketing mix modeling was kind of a once a year thing that people just ran once, took a look at it, put on the shelf. Now we're actually seeing that it's becoming much more ingrained in the day to day. A lot of our brands are updating their models monthly, quarterly. And they're using it as more of an always on type of system to evaluate their performance. The halo is just the value that you're getting when you place those dollars at the top of the funnel that ultimately gets attributed to a lot of the other things. Your CTV ad, ultimately that sale gets attributed to the Google or whoever is kind of at that bottom of the funnel capturing. So really what we're thinking about is like, how do you make that bottom of funnel work more effectively? How do you make sure that funnel stays full for you to capture and not just over index on that bottom?
Hello and welcome to a very special podcast series from the DTC podcast. For years, growth had something close to a cheat code. You put $1 into Meta, you got a customer back. You could watch it happen in the same day. So that's where a lot of the money went for many, many brands. But that's been getting harder. Costs have climbed, returns have compressed, and more brands are running into the same wall. Buying your next customer isn't the same as building a brand people come back to again and again. And building a brand usually means spending in places that don't pay you back right away, places where you can't draw a clean line from dollar to sale. That's a hard thing to defend because the job now is proving what you spent was worth it. That's the big idea behind this series. Better measurement is what earns you the room to make bigger bets. When you can see what's actually working across everything you do, you get the confidence to spend where the payoff isn't obvious yet. That's the halo. And learning to harness it might be what separates the brands that keep growing from the ones that just keep buying customers until the math stops working. This is Harness the Halo, a 6-part series from DTC and Keen. Over the next 6 episodes, we'll be talking to the people making these bets and the people who have to sign off on them. To kick it off, I'm sitting down with Justin Jefferson, VP of Strategy and Insights at Keen. Justin has a view across hundreds of brands and their numbers, and about as clear a read as anyone on what's working right now and what isn't. He's been on the show before, and he's the right person to start with the state of things. Justin, welcome back to the DTC podcast.
Thank you. Great to be back, Eric. Looking forward to jumping into the conversation.
Yeah. So you spend your days really close to the DTC market. Set the stage for us. What has changed maybe over the past couple years for brands, and why is it getting harder to grow the way that they may have used to?
Yeah, no, I appreciate that. Just for context, I actually work for a marketing mix modeling type company that has not only the historical performance, but also the future looking planning and optimizations. And we work with a little over 450 brands, a little over $45 billion in investments. So we have a good eye on kind of brands that are, less than 100 million, less than 50 million, around 10 million or so, all the way up to north of $1 billion in revenue a year, right? So we have a kind of a pretty wide spectrum of who we're being able to support, understand kind of how performance is playing out for them. And you are very correct with a lot of what you said at the outset. I think it's very much worth saying that, like, at the end of the day, the Meta game, the Google game, it's changed. It's become a lot more competitive. They're auction dynamics. So by default, you're going to start to see more and more expensive impressions, clicks, etc. And so being able to just kind of pop $1 in there and be able to see your, brand grow is really not the street that we're on anymore. We're playing a much different game. And at the end of the day, as you mentioned, we're in a world these days where the journey for the customer is becoming more diverse. There's more channels, there's more platforms, there's more ways to get in front of that customer. At the same time, a lot of the market has just been historically anchored on the Google Meta playbook, right? Of just, I'll do some Meta, I'll do some Google to capture it, and that'll be my whole, ecosystem. And what we're really seeing here is that at the end of the day, those are becoming more and more competitive. So the dollars aren't going to be able to be as efficient or as effective because, you're just having to pay more. But you're also essentially at the same time losing some of the visibility into the performance and the attribution at that lower level. And so there's this kind of world where as the mix is kind of becoming more diverse and brands are having to spend across more channels, they're also losing visibility into that attribution and what's actually working. If we think about just those kind of platform specific reporting. And so in this world, brands have really had to start to think, outside of the box on kind of how do I make sure my dollars are still working for me? And, oftentimes brands ignore that top of funnel, that more awareness, more, kind of the driving of the actual brand interest because, those are harder to track. But thankfully, over the last year or two, I would say that measurement has kind of caught up a little bit more in the marketing than where it has before. Obviously, I think Previously, marketing mix modeling was kind of a once a year thing that people just ran once, took a look at it, put it on the shelf. Now we're actually seeing that it's becoming much more ingrained in the day to day. A lot of our brands are updating their models monthly, quarterly. And they're using it as more of an always on type of system to evaluate their performance. Add that to incrementality as well. Like that's also helped to drive, a lot of that understanding of kind of what does that top of funnel do for us. And so while a lot of people have been just over indexing at the same couple of channels, we have started to see brands that have expanded outside and see really strong performance. So it's been a very, quickly evolving type of market where, you have the haves and the have nots.
I hear it on the podcast all the time. I have so many brands talking about TikTok Shop kind of rivaling the size of their meta spend at this point, but the huge amount of work that it takes in order to take on the TikTok Shop scaling, multi-thousand, 100,000 affiliates kind of situation, and what a juggling practice that is to kind of keep that going. But it's crazy to see that it can rival the scale of something like Meta. I'm hearing about YouTube as a top of funnel, not only for the Google suite, but for a brand's entire digital funnel, essentially. WhatsApp, streaming is coming up again and again. And these are all things that are sort of outside the normal workflow, maybe, of the traditional, like we say, Google Meta playbook. Is there a size of brand where it really becomes essential to start looking beyond Google and Meta? Is it, because I know brands, just starting out, you really can, find your product market fit. You can get your traction. You can build a great business on those two platforms. Is there a scale that you see brands really starting to think more about these bigger bets at top of funnel than others? Or is it sort of really dependent on the brand?
Yeah, there is definitely a trend based off of scale that we see. We can look across all of our customers' portfolio and pretty much say, like, as you grow, the amount of investment or your share of the media dollars going towards more top of funnel awareness type tactics increases, right? If you look at the largest brands, they actually spend more there than they do more on capture. Look at the smallest brands, they spend a lot more on capture than they do on kind of demand driving. And so there is that kind of natural progression that we see across. But I would say it's less so about like your annual revenue at any one point, and it's really the marginal investment returns. And that's really what we like to focus on is like ROI is just, hey, how much did you drive and what was the value of your investments and what you get back? mROI, or that marginal ROI, is really the concept of like, where are you on that return curve, on that point of diminishing returns? How much are you getting back for that next dollar you invest? And really that's where we find that kind of impetus to really start to flow those dollars up the funnel. Because at the end of the day, what you're going to do is you're going to overinvest on the bottom of funnel, and you're going to invest earlier in the stage in a way that's capturing the demand and helping the brand grow. But at some point, you're going to essentially maximize that, and you're just paying more to not really be able to drive incrementally new customers. And so in that world, you have to start to drive the demand that you are then able to capture better. We actually, this has been a fairly common topic for a lot of our brands as we've been really trying to advocate in this forum. And we've had a couple case studies that we've been able to elevate, 2 positives and 1 negative. But what we've ultimately found is that brands that have started to move those dollars to top of funnel have been able to kind of break out of that kind of stable, consistent sales and be able to start to trigger more growth. But it takes 2 things. One is really good strategy, being able to understand like, what are those right types of channels? How do I make sure I'm monitoring and not overspending on those? Where are my audience at? How can I best meet them? But 2, it also takes, I'd say, the appetite and the kind of the right confidence. One of our kind of, bad case stories is actually where a customer went pretty much from 0 to 100, where they had very minimal top of funnel, but they went overly aggressive on that top of funnel. And they actually saw some sales volume loss in the first year. And that sales volume loss led the brand to ultimately start cutting their budget, right? And that meant that they couldn't actually have the budget to capture some of the demand they were driving. Whereas we actually have another side of the coin, which is more of an online, mostly golf apparel, golf supplies. They were a little bit more, I would say, deliberate in their approach. They hadn't really done a lot of CTV, a lot of linear TV, a lot of audio. And so they started leaning into that. In the first year, they saw, pretty similar revenue sales volume, nothing too significantly changed. Maybe I think we saw maybe plus 5%, but the next year is actually where we saw the revenue start to take a shift. And so we saw actually, I think, around 23% growth in the following year based off of the investments beforehand. Because at the end of the day, there's a significant time lag here that you have to be comfortable with and you have to be okay with. And if you expect that top of funnel investment to pay off next week, next month, you're not going to see those returns and you're going to immediately either flip or kind of overcorrect. And so it's really about like taking that right approach, but being willing to make the bet and wait till that bet pays out.
Can you give me some examples, or if say you were running a $10 million brand where you had you really have your funnel dialed on Meta and Google, and you're looking to like grow the top part of your funnel, how would you think about that? How would you think about which platforms to extend to and how much of your budget to extend into those new channels?
I think it's a tough question. I'd say there's two major concepts that I'd like to explore here. One is when you talk about shifting that, a lot of people think take from the bottom and support the top. It's not necessarily the best situation because at the end of the day, your bottom of funnel tactics will become more effective when you have top of funnel presence. And so when you're trying to do more of that top of funnel, you still need to keep that bottom of funnel to be there to capture it and make sure that you're getting those sales. And so the first thing you really need to think about is like, great, I'm at 10 million. I want to grow. I need to incrementally invest in my top of funnel. I can't just rob one to pay the other. And so we've seen a lot of bad happen from that, but like ultimately you have to kind of grow them both. The other aspect is really just the minimal amount of investment you need to actually run any new channel, right? Every, linear TV, CTV, they all take a creative asset that you kind of have to put together that takes time, money, investment. Like there isn't an easy on off switch like there is on Google, right? With some of these top of funnel tactics, you have to really have a good strategy and spend the time getting ahead of it. And so the formats that are acceptable for the creative assets on TV versus CTV versus, social versus audio, if you want to do more podcasting, those are all going to be different. And so you have to really think about what are you willing to lean into to develop to be able to support the brand. I would say from our perspective, what we see in the data is that going more top of funnel, it's pretty much TV, video, social, display, and audio. And I'd say like TV and video, like TV is obviously the largest piece. Video is the quickest growing piece. And then audio is actually kind of growing pretty significantly as well, but starting from a much lower base. And then, obviously some of the social can be used for both top and bottom of funnel. So if I'm trying to, slowly start to expand, you can do it across some of the social because it's probably a little more easy, a little bit more kind of intuitive. You already have those platforms probably up and running. If I wanted to make a bigger bet, I'd probably go into CTV. CPMs are a little higher there, but they've been paying back well from what we've seen in performance. And I'll throw out audio as probably my dark horse. We've actually seen a few brands kind of lean into the audio side and see kind of outsized performance from what they would have expected. So those are probably be the ways I think about it.
When you say video in this context, do you mean sort of like on the digital web, essentially, like video on the web, or when you say video in that pantheon there, what are you referring to video?
Yeah, online video is certainly one of the things, but more of the connected TV is also what we're seeing grow, right? That's really where that growth is coming from. Don't get me wrong, YouTube is still doing well, especially on the short side. Like that's become a little bit more common, but CTV is kind of really the biggest top of funnel channel we're seeing growing.
Talk to me about how a platform like Keen would allow this hypothetical brand that we've talked about that's at that maybe $10 million mark looking to grow their top of funnel. How does a platform like Keen get predictive where it can make a brand feel confident in taking one of these bigger swings where they do have to have a big strategy? They do have to invest in creative more than they were previously outside of their workflow that they've currently been doing. How does a platform like Keen give them the confidence to take those bigger swings?
Yeah, ultimately, there's a few different ways we attempt to do this. One is that Keen actually uses a Bayesian approach to our modeling, which means that while you may have never invested on a specific type of tactic, we have 400 plus other brands with 45, $50 billion worth of investment where we've seen brands like you expand into new channels. And so we can kind of give you a relative kind of average or benchmark or kind of range of expectations for what you might see. We have a forecasting capability where we actually show you the kind of optimized plan, but also the associated sales volume and revenue tied to that plan. And we can provide that in kind of a probabilistic approach where you have kind of a curve of, based on the probabilities, what you're likely to achieve. And so when we're trying to give confidence to our brands to say like, hey, you know what, we think we should move from here. This is the way we do it. We run different plans to say like, you keep your same mix, you spend more concentrated on the bottom of the funnel versus, hey, we add an incremental 200,000, a million, whatever your budget you can sustain. We add that to the top of funnel. We run some plans. We compare them. And ultimately what we'll be able to show you is not only like the incremental revenue you see, but over what duration of time. I think that's probably the most important concept because everyone is just hoping to see that revenue instantly. And what you actually have to give them the confidence in is that it's going to come, but it's not going to come exactly the timing you execute. It's going to come over this window and kind of this lagged payout. And so when they can understand like, hey, other people like me have seen success. There's probabilities. There's kind of a range of expectations. I can de-risk my plan by, either investing more or changing some of the allocations. But also, here's kind of the expected payout and over what time period that enables the finance and the marketing team to better speak to each other. Because sometimes, finance is always looking at to close a book. What did you get, for me, the end of this calendar year, at the end of this quarter? Whereas the marketers are looking at investment as really something that pays out over the long term. And this helps them kind of conceptualize, here's the payout over the long term. And if you discount those future revenues back to their present value, this is the type of return you would expect.
And then I want to go back to audio for a second because I did a podcast or an interview recently with someone who specialized in radio in specific, and it was sort of real blast from the past. And if I think back to like radio, you're getting incredible CPMs apparently on radio. You're reaching an older audience, definitely, who in theory is more affluent. They're sort of captive. They're there. When you say audio, how do you break down the opportunities within audio?
Yeah, and I think what we typically think about is there's terrestrial and then there's digital. Terrestrial is that kind of, older AM, FM, like I'm just getting, publicly on the airwaves. The digital side is really where we're seeing a lot more of the traction and a lot more of the expansion happening in that area. Mostly around podcasts that we're seeing some good buy-ins, but honestly, like even retailers are starting to, like retail media, they're starting to open up audio. A lot of different platforms are starting to find ways to, expand that type of inventory and to bring more top of funnel awareness inventory to market. So whether that's, just being a partnership on a certain, brand event and having some kind of audio type advertisements over the fact, partnering with, a specific podcasting platform. I'd say there's kinds of different ways, but I'd say the digital side is obviously where you can get more accuracy on the targeting. You can kind of have a better sense of like how those dollars are being deployed and tracking them.
And to back up even further, beyond individual channels, a lot of marketers want to know how normal they are. So like at this 8-figure mark, say 10 to 15 million, what does a healthy spend to revenue ratio look like overall? I've seen some interesting tweets lately about people saying, if you're spending X amount of, on marketing, you're really on a treadmill that over time could be a losing game if you're spending that much to always acquire customers. So at this hypothetical $10 million mark, what does a healthy spend to revenue ratio look like overall?
I'd say in the 15-ish% range. And like roughly it's kind of an average of what I'd see. Like 20%, more than 20% is where you start to, make sure that it needs to be paying itself back. But kind of like we talked about with the amount of investment in top of funnel, we see that obviously scale with the size of revenue that you're getting. When you are in that kind of 10 to 15 million a year, you're probably spending in that 15 to 20% of your revenue back into the investments in marketing. When you get to the 100 to 500, that actually comes down closer to 10% to 8%. You get a 500 to a billion, that actually gets closer to 5%. After a billion, you're looking at really 2 to 3%, right? So it is most of this, like you have to buy ahead, you have to invest in driving that base of customers so that you can be more efficient with your dollars later. But when no one really knows you, you kind of have to buy those customers and then make sure you have a good product and a good offering to keep those customers in your site.
Let's talk about the halo. This was a rhetorical flourish that we kind of came up with together. This just because I like alliteration, so harness the halo makes perfect sense. But marketers are always looking for these flywheels or ways that they can combine the dollars they put in to get 2x the dollars out on the other side. I would say the halo that I kind of hear most about these days is maybe the TikTok Shop and Amazon. And like if you're gonna invest heavily in TikTok Shop, you're gonna capture a lot of that demand, not on TikTok Shop because people are maybe unfamiliar or maybe they got ripped off because they bought baby weights one time like I did. And so they see this really defined halo from TikTok Shop into Amazon. How do you think of this term, harnessing the halo? And maybe do you have any other examples of like effective halos you see being created by one effort that helps bolster another?
Yeah. Like at the end of the day, when I think about harnessing the halo, to me, it's the halo is just the value that you're getting when you place those dollars at the top of a funnel that ultimately gets attributed to a lot of the other things, right? Your CTV ad ultimately the credit goes to your Google search ad, right? Because they see something on TV and then they go search for it. And then that sale gets attributed to the Google or whoever is kind of at that bottom of the funnel capture. And so really what we're thinking about is like, how do you make that bottom of funnel work more effectively? How do you make sure that funnel stays full for you to capture and not just kind of over index on that bottom? From our side, what we see is like TikTok, social, those are very popular for the top of funnel. I think we've seen like TikTok itself has actually become more efficient, especially because some of the costs were depressed relative to the other social channels when there's a lot more uncertainty around that platform. Obviously, once there was a little bit more kind of regulatory clarity there, people leaned back in and started advertising more and have seen really good performance because the CPMs were just cheaper. But ultimately for us, what we really want you to think about is like, how can you connect those non-capture tactics to the efforts and the timing of what you're doing through an application like what we offer? We're able to kind of model out these exposures and understand kind of when you're starting to see and understand the value of the halo. I wish there was just like these 2-channel combos that you could always, execute, and that's the perfect halo. That's really not the case. As much as we've tried and seen people try that, it's really about just kind of finding the appropriate channels and then testing our cost across each of them. I will say one of the most interesting stats I've been able to find recently is that when we segmented our business into growing versus non-growing brands, the brands that were growing more than 5% a year and also seeing improvements to the ROI actually had a more significant change in their mix from year to year than the brands that were not. And ultimately what we kind of learned as we dove in, we were realizing the brands that fit into that mold were just test and learning more. And they were being more active about it, being more kind of diligent about it, and being willing to take bigger bets and see how they paid out, fail fast, and continue learning. The brands who just kind of, slowly shift their things, year by year, they're going to go stale and be stable and, eventually decline. So for us, it's really about making a big bet, willing to take the time to evaluate how that bet pays out, but then willing to, be able to shift and change course if it's not really paying out the way you want.
Are there any other sort of commonalities that you see among the brands that are growing 5, 10, percent a year versus the ones that are stagnating?
There's definitely a few. Probably one of the most obvious ones is the relative investment levels. So brands that are winning and growing at this level, I'd say we're typically seeing their investment in the plus 10%. Brands that are not are usually sub 10. And obviously you want to normalize that for the size of the business, but there's usually a 30 to 40% clip difference on how much more they're investing from a reinvestment rate than the non-winning brands. So obviously you need to invest more to grow. It's a pretty obvious one. But I think when we're looking at it, the marginal ROIs is really where we see the biggest delta in our brands. So if we look at all of our tactics for each of the brands, what we typically see is those stable declining brands, their return on their next dollar is sub 70, sub 60 cents, where their historical ROI might be above 1, right? Might be 1.3, 1.4, looks healthy, looks great. But they use that as almost kind of self-reinforcing evidence to say I should be investing more into that when they're not really seeing that they've actually crossed that point of diminishing returns. And they're actually just kind of they're paying more for the customers they would have gotten anyways. We see that a lot on search and Amazon search specifically. And Amazon has a massive market. The volume you can get on Amazon is amazing, right? That's been the case for years and years and years. But I think what a lot of people have really kind of not necessarily spend as much attention on is the fact that Amazon search is very competitive. You're going to be paying more and more. And like if you have a top of result page listing anyways, it might not bring that much more incrementality to your business, right? Like when you're at the bottom of the results page, when you're doing searches, like yes, you kind of need to be there at the top to make sure that you're getting the exposure. But once you start to see your products kind of moving towards the top of the page, like you're not necessarily going to get the same incrementality off of that advertising. And so you should be thinking about like, okay, well, Amazon has a significant network. They know a lot of people, a lot about, your audience. They have a lot of offsite inventory as well. They have like more display side that you can get into. And so for us, like we actually see really strong performance from Amazon when you think about more of that display, that video, and the impact that they're seeing is not only on Amazon, but off Amazon as well, back onto your website. And so what we would just kind of encourage you to think about is like, just because it is your biggest channel doesn't mean it needs to be your biggest channel. Just because you're investing the most in it doesn't mean you need to continue investing kind of the biggest portion of your budget in there. You really need to start thinking about kind of like how to right size that level of investment based off of the revenue you're getting out of it. And if you're investing more and not seeing more revenue at the top level, like it's a pretty clear signal, especially on a bottom of funnel tactic, that you should realize those changes soon. So I'd say like really thinking through like how to start moving more of your exposure out of just kind of concentrated areas.
I was just talking with a brand yesterday who was running into this problem where they had gone whole hog on their Amazon program, offered all their products for, but now Amazon is consistently beating them in their own Google results. So people are being driven to Amazon. So their conversion rates are high, but their margins are tighter because of the amount that Amazon takes there. Do you have any advice for a brand that kind of finds themselves in that situation where they are making sales, but they're kind of feeling like Amazon is taking a bigger piece of the pie than they would like?
I mean, that's Amazon's model to some extent, right? Like
That's totally.
they're going to squeeze you. Like at the end of the day, that's kind of the value of what they have is that they can bring you volume, but at the end of the day, like you're not going to get the profit there. And so all things being equal, if you think about an ROI as not only just the return on the revenue, but also the return on the profit of you're getting from each unit you sell, you're going to be getting more profit out of your own D2C website than you are going to be getting off of Amazon, especially if you take into account like FBA, their like commission rates.
Your first party data you're not getting.
Yeah, you're never getting an email
exactly.
to remarket to. You're never getting anything to be able to like grow that base and kind of deploy more email and other assets. So what I would say for a brand in that particular situation is just figure out how you can leverage Amazon's audience information to not compete directly on the Google search pages. And I think it's something I'm seeing across the board is that like retailers are advertising on Meta as well, especially like, the retail media networks are moving into more social Meta, and that's just only costing the CPMs to go up. So everyone knows that there's a few channels that you can find like, your customers on, and those channels are starting to be leveraged by not only that channel itself, right? Like Amazon's on Google, Target's on Google. Like everyone's kind of getting to these Google metas and like advertising on them, which is just driving up the auction costs, right? So it's just going to hurt some of your efficiencies there. So in my mind, it's really a question of like the market is getting more expensive there. Don't feel like you have to just keep upping your budget there because it is getting more expensive. Like find if that's the case, then like start to move offsite, start to move towards like ways to get in front of the consumer because, a brand like an Amazon or a Walmart, someone has that loyalty data, but not necessarily being directly on site where you're just bidding on search.
So when brands come to Keen, what often are some of the main questions that are being asked internally at these brands, but they're not able to answer cleanly that you guys help them with?
Yeah, I mean, I think the first thing we obviously have to talk about is the top of funnel. I think that's a big piece of what we see when a brand comes in. The vast majority are well overspent on the bottom and well underspent on the top of funnel. The average returns, there's a pretty significant gap. Sometimes it's 180 to 120, 140. It's a pretty significant gap where you're going to be getting 50% more back if you just start moving and having more dollars spent up the top. So I would say the top of funnel is obviously the big piece, but the interaction effect is also another aspect. At the end of the day, like, having just exposure on one channel just limits you to that one channel, but as you start to have touch points across different channels, it makes each of those more powerful. It makes each one of those kind of more effective, work harder for you. We see that 1 + 1 = 3 concept, where just by being able to be present in more different engagement moments with the end customer audience, you're able to convert them more efficiently at the bottom of the funnel when they're in that point. Another aspect is just the kind of what we call like war game planning or the what if planning. with our application, we're able to not only look at historical, but also plan for the future. And the future is more than just your investments. The future is your environment, your competition, your category, your like audience's sensitivity, like, how inflation is squeezing them. And there's so many other things that impact the business beyond how many dollars you're deploying on what channels. And being able to think through that, and be able to understand, what is the range of potential outcomes I might get if, my audience is starting to feel financially squeezed and doesn't have as much discretionary money. Like, how should we think about being able to kind of right size our investments for that, being able to right size our expectations on revenue for that. So that way we, feel a little bit more confident if we start facing some of those headwinds, we better understand what might be driving them and how to respond to them. And we don't knee jerk reaction and say like, oh, well, we got to just, throw everything out because it's not working and we're starting to see sales slow and we can't comp year over year by plus 5% like we have been. So something's got to change. We got to pretty much change our whole playbook. And that's a common thing that we hear is that, well, okay, I'm not hitting my year-over-year sales growth. I got to try something entirely different and just throw out my investment plan entirely. And so, what we really think about is like, what's it always saying is everyone's got to plan until they get punched in the mouth, right? You have to plan for getting punched in the mouth and what that might look like, so that when you do, you don't overreact. You have a plan for that as well.
It's a pretty punchy era. It's since I've started this 6 years ago. It's always been a boxing match, but I just feel like whether it's tariffs or the consumer pressures that people maybe are feeling right now, it feels like a very punchy time. Is that something you're seeing versus previous years? Is it actually getting harder?
Volatility is becoming more and more embedded in people's businesses. And I actually joined Keen in 2018, 2019. So my first, kind of foray into this was COVID, right? Like everyone was like, oh, how do I plan around this? And that's what the forward-looking simulations allow you to do. Like no one knew when people were going to start to be able to go out more, spend more. Like, so you just had to plan like, hey, what if it doesn't happen for the next year? What if it, picks up next week? Like, how do I start to respond based off of the trends I'm seeing? And that's obviously become more and more like not as many large significant ones, but a lot of smaller cuts, like, the tariffs, like regulations, like there's just consistent kind of evolving, like GLP-1s with food. If you're in, the food game, like there's just a consistent evolution of factors that are impacting what the business might predict, how the category is going to evolve. And you have to be, just ready, keeping your eye out, be, paying attention.
You mentioned a couple of mistakes. You mentioned this idea of like too rapidly investing too much top of funnel and maybe taking it out of the bottom of funnel so you can't capture all the demand you're creating properly. Are there any other like costly mistakes that you kind of see brands making over and over when it comes to both attributing and predicting their future growth?
From the attributing side, I think the costly mistakes is, again, we're here to talk about the halo. The costly mistakes is just kind of underappreciating the top, underappreciating the text to drive the awareness. When it comes for, really trying to make a strategic move in the right direction, the costly move is, thinking about it once a year. That's kind of one of the things that I've been most excited about with the evolution of measurement these days is that it's become more always on. It's become more iterative. It's become more, everyone in the market is talking about doing incrementality more often. At the end of the day, we've moved away from the set it and forget it. And I have a plan that I created at the end of the year, and I'm just going to keep running that to the point where like brands are just replanning every quarter. And like they're really stress testing, what makes sense, what doesn't make sense. And thankfully, because technology has allowed, marketing mix models and incrementality to be run more frequently, you can get those reads more frequently and make those adjustments more frequently. And so, I wouldn't say that, there's just one channel that everyone needs to stay away from or one channel that's, driving all the volume that you got to just buy into. It's really about just being nimble, right? At the end of the day, with a volatile world and platforms kind of evolving and kind of growing, and where people are kind of finding you evolving, like you just have to be very, very much nimble.
And just being willing to experiment, as you say, that you're seeing among the most growing brands, being willing and having, I guess, a solid framework in order to take bets. It's funny, as I play a lot of poker, and it's like if you just don't play any hands, like you're just gonna get drained of all your funds by the antes there. So you've got to be willing to take bets, to make bets, and have a really good system for understanding whether they're working, and have the patience and the measurement tools to understand how long it's going to take so that you don't panic. I feel like a lot of brands are in, we call it at Pilot House, the tactical spin cycle, where you're looking to like change tactics bottom of of funnel in order to drive conversion rate or AOV or these things. But when you're building a brand, you really have to be thinking long-term, and you really have to be able to make some bets at top of funnel.
Scared money doesn't make money, right? Like at the end of the day, you have
That's
to
right.
be willing to throw in and be willing to take a big bet. And I think from that tactical perspective, I see that all the time where like things are slowing down. So maybe brands want to restructure their campaigns. Maybe they want to change this particular targeting and this particular audience. And it's like, take a step back. If the brand is not moving in the direction you're thinking, it's probably not because of one little tactical difference. Like it has to be something more strategic. And, maybe you need to step outside of the day-to-day tactical optimizations to think about like, where does the brand really need to focus?
Well, I'm excited for this series. We're going to have a series of keen leaders as well as some brands from your side, some brands from our side who are all kind of making these bets. They're all in the arena, in the boxing match right now, talking about how they're doing it. I'm excited to explore this harnessing of the halo with you guys.
Absolutely. I love the topic. Very top of mind. I will say, just the final thing on this note is that it's becoming much more commonly spoke about, but from our data, it's still early in the trend. If we look at brands over time, like the dollars have just started to move more there, and brands who are doing well are kind of leaning more into it. But there's a lot of brands who have not really pushed this envelope that much, and so I love that we're diving into it because I think this is the message that brands need to hear over their head, over and over again to start and make those moves. And because we have both the historical and the planning, we can see that brands are planning at a greater rate of change than they have historically. So, I'm hopeful that execution follows the plan and we start to see more of that in the historical data. So love the topic and love the timing.
Perfect. Well, if you want to talk about this stuff more in depth, you want to talk with Justin, reach out to him, keends.com, Keen Decision Systems. Very cool. Thanks for coming on today, Justin. I look forward to the next one.
Absolutely. Thank you, Eric.
Thanks so much for listening to today's episode. If you're not a subscriber to our newsletter, you can do that right now at directtoconsumer, all one word, .co. I'm Eric Dick, and this has been the D2C Podcast. We'll see you next time.